Okay. So great. So initial part, it means I will move little faster because we have covered this, right? It means the vanilla derivatives we have covered, right? So, and I'm not asking questions because means we have to cover a lot of things out it. So, in finance, as we said earlier, the derivatives is a contract which gets its value from an underlying something, right? Actually, it could be an asset, it could be an index, it could be an interest rate, things like that, right? But the word derivative means it's derived from something else. It doesn't have, means say a value of itself, but it will derive its value from something else, right? As an example, if you're talking about, let's say, gold derivatives, right? It means then it will derive its value from whatever is the current price of gold. Similarly, if we talk about, say, equity derivatives, say a derivative for Tesla stock, it will derive its value from the current price of Tesla, right? So and the thing is that these derivatives contracts, although these are derivative contracts for a future date, right, but it can be settled two ways. It can be settled in cash or it can be settled in delivery, right? As an example, if there is a commodity derivative, right? So commodity derivative, let's say, means say a farmer enters into a contract with the, flour mill, right? Saying that I will supply 100 tons of wheat, right? Now, means say in the derivative, now in reality, the farmer would deliver those, means say wheat to the settlement location and get the money for that, right? But when it comes to exchange traded products, it means it can also happen that, means it's a contract where you are entering into this agreement, but you don't want to have the actual delivery. Instead of that, you are settling it in cash, which means that whatever is the spot price on the delivery day, you will adjust it against the whatever is the spot price, right? So you bought something for, let's say, $100, means 6 months back, and today's spot price is 110. So you agreed that, okay, on this day, whatever is the spot price, we will close out the deal at that point in time, right? So you don't have to really deliver the stuff, but you will just use that day's price, right? So that's how the speculators trade, right? So whereas it means the real manufacturers or the people who really means say use that product, say they would want a physical delivery, right? So if a flour mill has entered into an agreement, they would want a physical delivery. If you have entered into an agreement for oil, right, say crude oil, then you want delivery for your crude oil, right? It means so it depends, means what kind of contract it is, and it would be clearly known ahead of time if it is going to be a cash settlement or by delivery, right? I mean, say you cannot say that a farmer and you agreed into a contract to buy, say, 100 tons of wheat, and on, let's say, 31st of December, and on 31st of December you're saying that, hey, you know what, I cannot take the wheat, but I mean, say whatever price I bought for and whatever price is current, I will just pay you the difference and I will not take the wheat. The farmer cannot store it, right? So you need to have a clear understanding of it. Is it going to be settled by delivery or is it going to be cash settled? Okay. So derivatives contract can be cash settled or by delivery, right? Now, there are different types of derivatives products, right? It means options is one of the derivatives product, which means is like an insurance, right? So if you buy a call option, right, it means on anything, you get a right to buy, but there is no obligation to buy. Similarly, if means we'll look at an example, right? So if you buy a put option, which means that it gives a right to sell, but there is no obligation to sell. Okay, so it's like an insurance. Say that you say that I am going to buy 100 tons of wheat from you on 31st of December. Means at let's say $100 per ton, right? On that day, wheat price is 90. I don't have an obligation to buy. I just have a right to buy. But on that day, if it is 140, I will definitely buy it from you and sell it in the market, right? But if it is a lower price, then I will not buy it. I don't have an obligation to buy. Similarly, it means, in case of put option, I say that, okay, I am going to sell 100 tons of wheat to you, but at $100, but on that day market price is 140, then what I'll do is that I will sell it in the market. I will not sell it to you. So it gives me a right to sell, but no obligation to sell. So call option is something which gives a right to buy. Put option is something which gives you a right to sell, right? So naturally, it means there would be certain terms on these things. We will look at it, right? And
So
then third,
Ajit here is like a call, because this is call option, put option. I use so call option means okay, I do have something, I do have the goal, but it is not necessary I have to be sell to you. I can sell anyone.
yeah, exactly. So we'll look at an example in a minute. Okay, just hold on for 30 seconds.
Mm.
Okay, and warrant is the third kind of option product, which means say you have a warrant which gives you right to buy from the company on any future day. Okay, whatever is the date of the warrant. So in a call option and a put option, what was happening is that you were say dealing in the exchange. Okay, in the stock exchange or in a commodities exchange, you are dealing in that. Whereas warrant is another option that gives you right to buy from the company. So for example, if you own a warrant for Tesla shares, then Tesla will issue you new shares, right? Whereas it means if you own a call option, then Tesla is not issuing you shares. It is already existing shares. So you are dealing with a broker who is going to give you the shares, or it means whoever is the counterparty who is selling it, they are going to give you shares from the market. They will buy from the market and give it to you. But or whatever they have, they will give it from there, right? But when it comes to an warrant, it will be delivered by the or it will be, it means the shares will be given by the company who is going to issue it. Okay, so it's like a new share which would come to you, whereas it means in the other cases it is the old shares. Let's look at an example. Okay. Before that, there are two more terminologies which you need to know. One is an American option and the other is an European option, right? So American option is an option which can be exercised at any time prior to expiration date. What it means is that if I say that, okay, I'm going to buy, say 100 shares of Tesla from you at $220, means, and your exercise date is, let's say, 31st December. So if I have that contract with you, which means that if I have an American option contract, then from today till 31st of December, at any point in time, I can buy the shares from you. Okay, which means that term is called exercise. So I can exercise my rights at any time from, means a contract date till the expiry date. Between that, any time, it can be, next day, it can be after 10 days, it can be after 6 months, but within that, contract date, right? And then there is another kind of option, which is called European option. The European option can be exercised only on the expiration day, which means that, means if I said that I'm going to, say buy 100 shares from you, then it will be only on 31st of December. So you don't have to worry, means say in between the market price has gone down, you can buy at that point in time and then, say deliver it to me at, whenever the person is asking for, right? So you can exercise it on that expiration day. If it's only allowing you to exercise only on the expiration day, then it's a European option. But from between the contract date and expiration date, if you can exercise it anytime, then it is called American option. Okay, there are two types of options which you need to know. Again, it means it's not a huge concept. So it's like, means say you have a right to buy something. So from today to 31st December, anytime, it means if you can buy, you can go and pay the money and buy it. That's an American option. But you can buy only on 31st, then it's a European option. Is that clear?
Yes, Ajit.
Okay. So let's look at an example of a call option, right? So as I said, that call option gives you a right to buy, but no obligation to buy. Okay. So we have a Tesla call option, American option on 29th September, right? And strike price is 12.20 and premium is $10. So you just pay $10, you get a right to buy at 220 on any day before 29th September. Okay, so this is a call option where you have a right to buy, and at the strike price, whatever is the agreed price on the premium, whatever you paid, right? If you can buy any day between this, then it is a American option. If you can buy only on 29th September, then it will be European option, right? So they will clearly call out if it's a, call American or call European. So most of the equity securities are traded as American options. Okay. So this gives you, actually means a right to buy 220, I mean, say Tesla shares at the rate 220, right? On or before 29th of September, but there is no obligation, right? So premium is $10 per share. If you want to buy, it means it's typically in a lot. The lot is of 100 shares, then you pay $1,000. It will give you right to buy 100 shares at any time between now and 29th September at the rate 220. But you don't have an obligation. Tomorrow Tesla goes to 180, you don't have to buy it, right? If Tesla goes to 300, you have a right to buy at 220 itself. Tesla become 500, you still have a right to buy it at 220. You will get it at 220. Okay. So that is call option. Similarly, put option, as I said, right? It means it gives you an option to sell at that agreed price. So if you want to sell Tesla, if Tesla price is 250, you don't want to sell, right? So you will not sell it to the person. But if Tesla price became 180, or it means just like anything between, so you paid a premium of $10, it's 220 is the current price, right? Or rather, it means your exercise price. So you will be making profit if you are selling it anywhere lower, if the price is lower than 210, right? So because your actual cost or whatever it means you're getting is that 220 minus this 10 which you already paid from your end. So if you sell anything, or if the price is anything lower than 210, then you will be always making money on that. Okay. Otherwise, means if it's 215, you will still exercise it, but then say you already paid 10. So you got 215. So your net is $5 loss from your pocket. Okay. So the key thing is that you're getting a right to sell by paying this premium, which means that it's like your home insurance, right? Or your car insurance. So if anything happens to your car, you will get it reimbursed by the insurance company. Otherwise, your premium is gone, right? It means till the coverage period you will have the insurance cover. Similarly, here you have an insurance cover to sell Tesla at that price, whatever is agreed. And means if it is lower, you want to sell, you can sell it and get that money, whatever it means, that 220, you will get it paid at that rate. Okay. So that's a simple concept of derivatives. We discussed it earlier. So call option and put option. Right? Any questions?
Ajit, I have a question here.
Yeah.
So basically, there is a concept called lot size in derivatives, right? So it changes with crude oil versus gold versus the nickel. So how does that lot size is defined normally?
Sorry.
How does that lot quantity is defined? I mean, for gold, it's like
sure.
It could be like 10 and other.
Yeah. So it depends on the exchange, whatever rules they have created, right? So for example, some exchanges have this thing saying that, okay, minimum contract value, right? So, say Tesla is $100, and if the exchange says that, okay, so it means our minimum contract value is $10,000, then the lot will be of 100 shares. If, means another company has $10 shares, so in their case, the lot will be $1,000, right? So exchange decides that, okay, what is going to be the lot size for this one, and typically they would have already published a rule that how they are going to do it, right? So most of the exchange, for example, in NSE in India, they have 100,000 rupees as the minimum contract value. So the lot size will be typically based on that.
Okay, got it, Ajay. Yeah.
Okay. So that's how they decide. So exchange decides, and then once it's decided, that is fixed. So you are actually buying in lot, and once you have to buy that minimum lot, whatever it is. Okay. And in multiples of that lot.
Because we generally see like TCS is like 3,000 shares, or like 25 shares, but sometimes idea could be like 3,000 shares.
Yeah.
So I just wanted to understand.
1 lakh rupees is the limit out there, right? It means around that. So it doesn't change every day. So every 6
Right.
months or something, they will revisit it, and if they need to change, because there are live contracts in there, right? So you cannot just change it whenever the price goes up or down. So they will means revisit every 6 months or so. I don't know the exact time. What is it? Depends on the exchange again, right? So they will revisit it and say that a contract needs to be adjusted. Just as an example, somebody gave a split the stocks, right? Now you have a $1,000 share or ₹1,000 share, and you had 100 shares. So it was meeting your 100,000 requirement. But now it has been split into 1:10. So your each share is only $100, and the 100 share lot means it's 10,000, right? So that doesn't meet the requirement. So they will split. They will readjust it. Okay. So it depends on exchanges. Whatever number they want to keep it, they will keep it that.
Right. Yeah.
So the next type of derivatives is a forward derivative contract, right? Which means that you are agreeing. So in the first one, the options, you had an option if you want to exercise or not, right? The option was with you, and that's why it is called option. Okay, it gave you right but no liability and no obligation. You had an option, that's why it was called options. There is another one called forward derivative contract, right? So forward means you are getting into an agreement, right? To means execute. You're getting into a contract where you are agreeing to buy or sell something on a future date. Okay. So, but unlike an option here, it is mandatory. Okay, so that's the key thing. Requires the payment of the agreed forward price in exchange for underlying asset on by the maturity date. So you need to pay for whatever you are buying by that day. Okay, so you cannot say that if you said that you are going to buy 100 shares of Tesla at 220 and Tesla share is 150 now, so you cannot say that no, I will not buy this. Okay, or if Tesla becomes 250 and you agreed to sell, you cannot say that okay, I will not sell because I want to use an option as such of not delivering. But that's not an option because you have traded in a futures contract. If you want that flexibility of or no obligations out there, then you have to look at forwards, or rather you have to look at options. But if you want to buy or sell something on a future date, which means that you don't have money to pay today, but you want to buy for a future date, then forward contracts or futures contract is something which you look at, right? So there are two or three different types of contracts which can happen in forward market. One is a swap contract. Okay. So swap contract is a contract in which you are exchanging two cash flows. Okay. So if I have to give a simple example, right? It means the cash flows, where two parties are exchanging whatever is the income which they are going to get, right? A simple example could be that, okay, you and me agree.
Ajit, sorry to disturb. I think so in WhatsApp, someone is asking the link.
Oh, let me check. Let me check what was the link also. It is okay. Okay. So yeah. So if you have to look at swaps, right? It means think of it this way, that means you and your friend both think that the other person's job is much better, right? You joined an IT company, and your friend joined an investment bank, and your friend thinks that IT jobs are cool, man. It means you joined a startup, you get means a big bonuses, or it means a big ESOPs. Whenever your company is sold, you're going to make big money. You think that investment banking jobs are cool, means you get huge bonuses when you have a good year. So both things that other person's job is much cooler, right? And you guys decide that, okay, so I tell you that, okay, if you think my job is cooler, so why don't you take all the salaries and anything which I'm going to get in the next, means say 3 years, and I will take whatever you are getting in the next 3 years, right? So we agree to swap our salaries, right? So you work for an investment bank, I work for an IT company, so we swap our salaries. So this way, everybody's needs are met, right? It means I think that investment banking jobs are cool and make you more money, so I take that from you, and you think IT jobs are much better, then I give all my salary and everything to you, right? So we're swapping the cash flows. Our cash flows are through salaries, bonuses, or ESOPs or whatever we are getting. Whereas it means say investment bank guy gets a bonus and salary, and the IT guy gets a bonus, in salary and maybe some ESOPs, right? So we will swap everything, whatever comes as the job perspective. So those are the cash flows out there. So similarly, it means in an interest rate swap, or say currency swaps. So there are different types of swaps. So in swaps, we are exchanging the cash flows, right? A simple example, we will look at detailed examples of swaps, right? So when say you today have a home loan which is, let's say, fixed interest rate loan, right? And it is 5%, 7% contract, you're stuck in it, right? Now you think that means interest rates are going to go down and you should be moving to a variable interest rate, right? So you enter into a swap contract, which means that you are means say currently you have a fixed price contract, right? A fixed interest rate contract, and you cannot come out of it. So you are swapping. So you go to a dealer and say that, hey, you know what? You mean say I will pay you, rather it means you pay me a fixed interest rate and I will pay you a variable interest rate, right? It means you enter into a contract, let's say $100. I say that, means say you pay me $5 as fixed and I will pay you whatever is the market interest rate, and you will have a contract. So $5, and let's say you have your home loan is at 5%. So what you do is that you take that money, whatever is coming in from the swap contract, and give it to the bank. And then, means say whatever variable rate you wanted to pay, you pay it through this new swap contract which is there. So I'll show you pictorially how it is done. So you're basically swapping the contract, right? And it happens a lot, right? It is one of the largest markets when it comes to trading in the OTC derivative space, and we'll take a look at that. So forwards are customized instrument to buy and sell an asset on a future date, right? So for example, when say we agree into, why is this warrant? Sorry. I have to add an example out here. I will do that. I'll explain it now. But when say you and me get into an agreement to buy, say 300 shares of Tesla on 31st of December, right? Now it is an agreement between you and me to buy 300 shares of Tesla, whereas the market lot of Tesla is, let's say, 1,000, but we conveniently created a contract of 300 shares. And when say the market norm is that it would be month end, whatever it means, right? And 1 month, 2 month, 3 month contract, we created a 6-month contract. So we customize the contract. So whenever you have a contract which can be customized according to your needs, which means it's not a standardized contract, or to buy or sell something on a future date, that is called a forward contract, right? So the key term out there is it's a custom contract, right? Customized instruments or customized contracts, right? Okay, these are customized contracts to buy or sell something on a future date, and that asset can also be customized, right? It means you can mix and match 2-3 products to create certain products out there, right? So you can customize it the way you want it and agree to buy and sell this on a future date. Okay. when you are selling standardized instruments or standardized contracts, right? I'll not make it complex. If I put it instrument, then that makes it complex. Okay. So if I have standardized contracts to buy or sell an asset on a specified date in future, then it is called, a futures contract. Okay. So the difference is that when it's a standardized contract, you can buy it only in lots, right? So Tesla can be bought only in the lots of 100, 200, 300, 400, whatever it is, right? So whatever is the lot. You cannot buy 150 shares of Tesla on a future date, right? It's a multiple of 100. If it's a multiple of 100, then it's a standardized contract. But if it's and it's called a futures contract. But if it is not standardized, it's a custom contract, say 150 or 170 Tesla I want to buy on a future date, then it's not a standardized contract, and that will be a forward. So that's the difference between forward and futures. Okay, so it's important whenever we use that word, we need to know that what exactly we're talking about. So we're talking about forwards, then it means it's a custom contract. If we're talking about a standardized contract, it is called futures. Any questions on this? Okay, so keyword is customization when it comes to forwards and futures. Okay, now derivatives are used for three purposes, right? It means one, it can be used for hedging or transferring risk. Second, it can be used for speculation, and third, it can be used for arbitrage, right? So let's look at it. So in a hedging contract, let's say you are a flour mill and you want to buy wheat, right? It means so you know that, okay, so on that given day if wheat will be available or not, right? If you are in US and Canada, and you know that say India has banned rice import and exports, right? So which means that there is not much of rice available in the world. India is the largest producer of rice, and now rice is not available as such, right? So if you have a derivatives contract, or if you had a contract wherein it means you had a protection saying that, okay, you are buying 1,000 tons of rice on 31st December. And if you have a contract like that, then whoever is the seller of that contract, they need to honor that, right? Wherever, whatever is the rice price, they will need to deliver the rice. Somehow they will have to deliver it, right? So you are transferring the risk, right? It means that the thing may not be available, all of those things, to the other person. Or you may buy it in the market for whatever price you're getting and then charge the other person. But you are de-risking yourself. Similarly, from a seller's perspective, seller is, means de-risking themselves. So seller says that, okay, I want to buy something, right? Or I want to sell you, 100 tons of rice at this price, so that I don't have to worry that if the price falls or price rises or whatever happens, I don't have to worry about it, right? So you are hedging that risk. Another example, as I said, that put option, right? So you have that, okay, there's going to be an important event. Let's say Tesla is going to announce its results, and it can move the stock either way, right? There are a lot of rumors in the market happening saying that somebody is saying Tesla's results are awesome, and they're going to give bonus and all of those things. But some others says that, oh, there is a strike in China and next quarter it is going to be very bad. Or iPhone, for example, right? It means China has banned iPhone. So so Apple's price has gone down by, or rather stock has gone down by some 5-7% in the last 2 days. Okay, so it has lost some $200 billion in value. So an event like that happening, so you want to de-risk yourself, right? So it means if you have a put option, then you are de-risking yourself. So you can still sell at the higher price, and you don't have to worry much about it. Typically, when it comes to important announcements in the companies or something big is expected out there, you go and buy call options or put options to ensure that your trades are protected. Okay. If you have any questions, then I can stop and ask me. Okay. So second reason is that you want to speculate, right? So if you think that market is going to go down, you go and sell it in future, right? If you sell a futures contract and a market goes down, you benefit out of it, right? So that's a speculation. And third is arbitrage, right? So it means you see difference between the spot price and the futures price, and you calculate that, okay, you are able to buy, say, Tesla share for 220, and you see that 1 year down the line, somebody is buying Tesla futures for 242, which means that you are making a cool 10% returns out there, right? And you can borrow in the market for 7%. So which means that you're borrowing money from the market for 7%, investing in Tesla, buying it at 220 and selling it in the forward for 242. So which means that you bought for 220, you sold for 242, you have guaranteed 10% return. You are paying 7% interest. So your net profit is still 3% of Tesla, right? So you have a guaranteed return out there, and that is called arbitrage. Okay, so these are the three big reasons why you use derivatives. Any questions on these three? Okay. So, and the key thing in arbitrage is that you are trading at almost zero risk, right? I use the word almost because there could be a timing gap, right? Or there could be something where, say you said that you're going to do these two legs of the trade together, but for some reason, say one leg could not be executed, then there is always a risk out there. And when these traders trade, or these, when you trade doing arbitrage trading, at that point in time, you would trade even 1 cent or 2 cents. If you're trading for that low, suddenly something goes.
Ajit, I have a question on arbitrage.
Yeah.
Like, say, for example, arbitrage, what I understand is like if I'm getting 1 kilo of tomatoes from one shop and if I'm giving it to another shop with some price, that is arbitrage, right?
Yeah.
So I'm making some money out of it,
Yeah.
right?
Mhm.
So, like, say in India, like there is NSE and BSE. Say if I have TCS like for 3,000 and in NSE and in BSE it is sold at like 3,120 rupees or something. Like there is 20 rupees of profit. Can I do that arbitrage on that?
Yes, subject to condition that you have deliberate.
Like subject to condition.
So what happens is that you are buying from one place and selling at different place. Okay. So which
Right.
means that you need to have money to buy it from one place, and wherever you have to deliver. So both are happening on the same day, right? Arbitrage means you're buying today and selling it at the same time, right? You're doing both trades together. So you bought it at, let's say, BSE, and you sold at NSE. So both settlement would happen on a T+1 basis. So whatever you're selling, you need to deliver tomorrow. Whatever you're buying, you're getting it only tomorrow, right? So which means that, to deliver in the market, you need to have shares already with you. So you already have, say, 100 shares of TCS, let's say. You sold 100 shares of TCS on NSE for 3,120. You are getting that money tomorrow. And you bought on NSE, on BSE, so you got your for this 3,000, right? So 3,000, it has come to your pocket, but you have to pay for that 3,000. Tomorrow you will again be in the same position, right? It means once the settlement is done. But otherwise, for the settlement to happen, you need to have money as well as securities.
Okay. Got it.
Right. So you cannot say do it at the same place.
Right. So people generally do the arbitrage.
Oh yeah, arbitrage is a big one. Big one, right? It means particularly when if I know that I'm able to borrow, means a cash fast, so I typically buy and sell it in future, right? So there would be softwares which would automatically that means which all securities are offering arbitrage opportunity. It will continuously show it on your screen, and you will be able to decide that if you want to execute it, right? So you create your screen in such a way that wherever you are doing the arbitrage trading, you
Okay. Yeah.
Okay. Yeah. So Varun, I think there's some background noise. So when you're not talking, just put it on mute.
Sorry, Ajit. Yeah.
Yeah, no worries. You have asked your question, no problem, right? When you're not talking, just put it on mute. That's okay. So, the important thing is that where are derivatives traded, right? So derivatives are traded on the organized stock exchanges as well as over the counter. Okay. So what's over the counter?
So it's
Bilateral
like
agreement
manual.
between.
Yeah. So when you have a bilateral trading, which means you and me enter into a trade, that would be a bilateral trade, and that will be an OTC trade, right? Which is the over-the-counter trade. But when you have a multilateral trade, wherein say you are buying, but there could be 100 people who are selling, right? You don't know who is selling, what's happening, and there is no no connection directly with the counterparty. Then that is called a multilateral trade or an exchange trade, right? So organized stock exchanges would always have multilateral trade. Okay. So in an exchange, right, it means that trades are always in standardized contract. When you go into say exchange to trade in derivatives, it will clearly state that okay, so you can buy options in a lot of 100 shares, or futures in the lot of 100 shares, whereas in the cash market you can buy even one share, right? So it will have clearly called standardized contracts out there, right? It will always, when you are trading in exchanges, there is a guarantee coming in from the clearing house, right? It means all the trades would be cleared by the clearing house, and this is all guaranteed, right? The means if it's a futures contract, so whatever is your daily profit and loss, that needs to be settled on a daily basis, which is called mark to market, right? So whatever is your means a security out there, if the price has increased, right? You bought something in future. Let's say you bought Tesla for a future date, say 220, and next day the future price has gone to 225. So you will get that $5 credit in your account. And the person who lost, right, it means that $5, their account will be debited by $5. So every day cash settlement happen for the outstanding position. Contract still remains, but whatever is the profit and loss on every day in your account, that will be adjusted on a daily basis. Okay, so that's called mark to market. Should be marked, not mark. Okay, so mark to market, and then you have mandatory margins. Naturally, exchange systems would have always have margins in place, so there is always a margin attached, and it's a low risk thing, right? So, and typically you trade futures and options in the stock exchanges. Okay. There can be, say, of course, there are commodities exchanges, so you can have, say, oil futures or grain futures and all of those things. Similarly, you have equity futures or in the equity exchanges. Okay. So I should not say that organized stock exchanges. It can be organized exchanges, because stock exchange means it's stock, but when say commodities exchange would trade commodities, and they also have futures and derivatives. So just read it as a marketplace, right? Organized marketplaces. There is another concept called cleared derivatives, or centrally cleared derivatives, or CCP, when say derivatives. So what happens is that it can be, again, standardized contracts, but negotiated bilaterally, which means that you and me enter into an agreement, and I tell the exchange that we have entered into this agreement, and it will be cleared by the means a CCP out there. Okay, so CCP would be your clearing corporation or clearing house or whatever it is. It means they would clear your trades, but it will be, again, it means the same kind, just like an exchange trade, but only difference is that here who is the counterparty, right? So all the fixed income trades which happen in the market, they are all centrally cleared, fixed income contracts. So equities generally happen on stock exchanges, but almost 80-90% of fixed income trades happen in this mode, right? Derivatives as well as means your regular fixed income trades, they are all centrally cleared trades. Third type of contracts are called OTC derivatives, right? So in an OTC derivatives contract, there is no clearing. It is a bilateral trade. So you and me enter into a trade. We have a custom trade. Okay, so we create a custom contract. We have a custom instrument, whatever we want to create, we are trading. And there is high counterparty risk in this case, right? So naturally, it means, say you and I are trading. So the settlement of the trade depends on if I honor the commitment or you honor the commitment, right? Both have to honor the commitment. Only then the settlement can happen. Whereas in the other two cases, there's always a central counterparty or the clearing house out there, which is going to ensure that the settlement happens. So your risk is low. Here in OTC derivatives, your risk is very, very high. Okay, because of the collateral or the counterparties, means involved in there, they are not covered by any clearinghouse. Okay. So how the cleared derivatives are, means executed. So here also, just as you know that this is a bilateral trade. So how it is done typically, these two counterparties would talk, right? It means they would talk and then they will use a execution facility to enter the trade details out there, right? So they will use a swap execution facility, would be a platform, or a fixed income trading platform. It means they would just put their trades in there, right? And once it is means data is put in there, it goes to the clearing member, right? And on the other side, the counterparty may be directly working with and typically it is the bank with which you are trading, right? So they already have a membership of the clearing house, and this guy means the counterparty directly works with the clearing house and pay the margin out there. Okay? So you pay the margin, and then means the counterparty takes over this trade and says that, okay, I am going to guarantee the trade. Okay, so you execute the trade between yourself first. Once the trade has been executed, you agreed on to the trade, you put it into the swap execution facility for matching and all of those things. If the trades have been matched, that's when the clearing house will take over this trade and will ensure that the trade is settled. Right, so it's a centrally cleared this thing. So which means that this trade is between you and means your counterparty. But as soon as means it has been executed and it has been put into the swap execution facility, then the clearing house will take over and then becomes the counterparty. So it will become your counterparty and also the counterparty to the client who are sold, right? So that's how the clear settlement derivatives work. When it comes to OTC, there is nothing. It's directly between, means the two parties out there, they trade and they carry each other's risk. Okay. Any questions on this? Centrally cleared versus exchange traded versus OTC. Okay. So if you look into OTC markets, right, it's huge. If you look into the outstanding contracts today in the OTC market, as of June 2022, it was $632 trillion of outstanding. Okay, it's that big of a market. The world economy put together is some 50-55 trillion dollars. So 10 times of world economy is being traded, or the notional value outstanding is 10 times of the world economy. Okay? So it's that big of a it's an industry as such, right? If you look into the total market capitalization of NYSE, I think it is some $40-50 billion, $40-50 trillion. This market is 10 times bigger than that. The world, the entire stock markets together across the world, it's around $120 billion, $20 trillion, and this is 5 times bigger than. So OTC outstanding notional values are huge. Okay, the gross market value, or which means that means whatever is at risk, right? It means a daily changes which happen in the pricing. It's around $18 trillion. Okay, the market valuation of means of those trades, like somebody is profiting, somebody is losing, that outstanding is around $18 trillion. So tomorrow, if the markets were to crash or something, this $18 trillion is at risk, right? Either one of those parties can default and all of those things happen. Right? So there are 4 different types of derivatives out there, OTC derivatives typically, which is traded, right? If you look into it, these are the large ones, right? So interest rate derivatives is the largest. Next is the foreign exchange derivatives. Third, which is the commodities derivatives, and fourth is the credit derivatives, right? So these are, means, say, four large derivatives. Let's look into different types of swaps out there. Swaps are one of the most traded instruments in the market, and there are four different types of swaps. One, as I said, that swaps is basically you're exchanging two cash flows, and we will look at all these examples. Okay? So interest rate swaps, when you are changing, when you're trading between fixed or floating interest rate, then that's an interest rate swap. Currency swap, when you are trading between, means a currency in, say, US dollar versus pound, right? It means, say, that's a currency swap. And we'll look at each of these examples, right? Total return swap. So when you are doing a swap between, an equity, returns versus a fixed income return, then that's a equity swap. If you're doing an index versus, means a fixed income return, then that's a index swap, right? We will look at examples, so don't worry about it, right? Similarly, credit default swap, right? So credit default swap is where, means you are betting that one company may go bankrupt and you're buying insurance against that, right? So it means you pay as an insurance premium kind of money every quarter, and you are buying a protection against, the company going default. If the company default, then the entire money will be paid back by the insurance company. Okay? This is pretty interesting, and we'll look at it now.
Ajit, one question. Can you go back?
Yeah.
Here, typically one leg will be the fixed price and other will be floating payment. Yeah, understood. Like each one position, it will create the two leg. One is fixed and one floating. But I didn't understand how the fixed payment and floating payment.
I agree. So let's look at it.
Hmm.
Okay. So I have an example. So I will show you all those things. So just listen to what I'm saying out here.
Yeah.
So interest rate swaps are forward contracts, right? Which means that, your settlements would happen on a future date. Okay. Forward contracts in which one stream of future interest payment is exchanged with another stream based on a specified notional amount, right? So notional amount is the amount which we are using to calculate, okay, how much is the interest payments out there. So for example, if you're trading, means say a home loan contract, right? So you have $1 million home loan and you want to, means say do a swap with it. So you will use that $1 million as a notional amount. So you're just calculating interest based on that, means whatever is the home loan amount, right? Or whatever is the amount you want to use as a base for calculating these interest, because you're exchanging only the interest out there, right? So the amount which you are using to exchange the interest or means calculate the interest is known as the notional amount, right? Because you are not really exchanging that money out there, right? You are just using that to calculate the interest. So that amount is called notional amount, right? It's not a real money which you are exchanging. It's just a notional amount used for calculating the interest, right? So in a interest rate swap, as I said, that, means a payer pays a fixed interest rate and the other person, means receives this fixed interest rate and then they pay a floating interest rate based on something. So floating interest rate we discussed earlier. So floating interest rate could be based on SOFR, which means that, means every night this interest rate changes, whereas a fixed interest rate is a fixed interest rate, whatever you agreed on to a contract, right? So amount of payments usually calculated using fixed and floating rate interest, right? Notional value is never swapped, right? So there's no point in, means say you giving me $1 billion and I giving you $1 billion, right? Because it's the same amount which we are using to calculate the interest. So notional is never swapped in an interest rate swap. And the swap's value initially is zero, which means that, means when you're starting the contract, the swap's value is zero. Right? It means that there is no profit or no loss to anybody. And for the swap contract, the interest rates are adjusted in such a way that, means say it in the initial payment value or initial value of that swap contract is zero. We'll take a look at it, right? How it is calculated. On the settlement days, let's say you're doing a quarterly settlement, then, on 3 months down the line or 6 months down the line, whatever it is, the swaps are again valued. right? It means, and then you look at it from a, or rather, it means whatever is that interest payment has to come in. So both interest payments are calculated. So whoever is getting more money, right? It means that party, rather, it means whoever has to get more money, the other party will, means pay that much difference out there, right? For example, so we'll again look at an example and calculate it, right? It means, so if you are swapping my interest rate, so let's say I am paying you fixed interest rate and I am receiving floating rate from you, which means that I will give you $100, and if I have to get 120 from you, you will pay me 120. So we don't do this 100 and 120 exchange, but we will do a net exchange, which means that you will pay me 20 and that is balanced, right? So you will always, it means exchange whatever is the difference. So it will be net settled. Okay. So let's look at an example how this entire process works. So, and so on 7th August, right? And this is a real case which I've taken from, based on SOFR rates, right? So on 7th August, Ford decides to enter into a 1-year fixed rate receiver swap contract, which means that Ford is receiving fixed rate and pay SOFR based floating rate, right? With a quarterly interest payment on a notional amount of $1 billion. So $1 billion is the contract amount, and Ford is receiving fixed and they are paying floating rate. Okay. JP Morgan and provides fixed cash flows to. So now this is, so when you start the contract, you look at what is the SOFR interest rate. So SOFR interest rate as of 7th August was 5.3%, 6 months was 5.2, 9 months is 5.1, 12 months is 5, which means that interest rates are going to come down in future, right? So somebody who bought a fixed rate contract today, they would think that, oh man, I'm stuck in this fixed rate. So let me do a swap so that I can buy a futures, or rather it means a floating interest rate. And that's why they enter into the swap, right? So whenever you enter into swap, right, it means, so this is the interest rate which is there. So you need to calculate what is the discount factor for the present value, right? So it means your future cash flows. Let's say you are getting $100 1 year down the line, right? It means its value is $100 1 year down the line. But what is its current value or present value? So its present value would be somewhere around, say, if 5% is the interest rate, right? It means its present value would be 95 point something, right? So we're 95 point something and 5%, that makes it $100 after a year, right? So if it's for any future payment, you need to first calculate whatever is the current, means a value of that, right? So if it's a $1 thing, then means a 3 months stuff is 90.98. If in 6 months its value is 0.976. If it's a 12-month thing, right? It means so $1 after 12 months is equal to 0.9524 today. Okay, so this is the discount factor for calculating the current value. Now we use this current value or discount factor using this formula to calculate a fixed rate, right? The floating rate, whatever is going on in the market. Based on the floating rate, you always calculate whatever is the fixed rate. That's how means all your interest rates work. So the floating rate, whatever is going on in the market, and based on that floating rate, you calculate whatever is the fixed rate for this thing, right? So this is the formula. So n minus, means n is number of whatever it means, say, payments to be made. 1 minus, whatever is that last discount factor divided by all the discount factors. So this is a standard formula. You don't have to remember this formula unless you're appearing for a CFA exam or something, right? But otherwise, it means your system will calculate and will give you all those details, right? If you're a trader, your system will calculate and give it to you, right? But if you need to code as or if you need to write specs as a business analyst, then this is the formula. You will be able to find it. Your business will give you this formula. You don't have to worry as a business analyst, where am I going to get this formula? Okay, there will be quants people within the organization. They will give you all these formulas and all those Excel sheets to validate all of those things. But there's a formula which you use to calculate the fixed rate. Okay, now you know the fixed rate, and now you know whatever is the floating rate. So based on that fixed rate, you know that, okay, so Ford will pay JP Morgan 12.275 in 3 months, 6 months, 12 months. Ford is going to pay fixed payments of this thing, right? Whereas what JP Morgan is going to pay to Ford is not known, right? It means it's known only for the next 3 months. After 3 months, whatever they are going to pay, what is that? If you have the 3-month floating rate, you know that, okay, whatever it is, right? So you agree on today, and this is what JP Morgan is going to pay. After 3 months, like in the 6th month, whatever JP Morgan is going to pay, what you will do is that you will see that on this day, whatever is the 3-month rate, that is the rate at which JP Morgan is going to pay. Then again, after 3 months, it means, say here at this position, you see that at this time, whatever is the 30-day or 90-day, SOFR rate, JP Morgan is going to pay based on this. So you will always calculate, your 3 months forward rate, and that will be used for calculating your payments after 3 months, right? So quarterly swap, that it means this is 12.275 million is what Ford is going to pay JP Morgan, and the first quarterly this thing, which is going to be 13.25. So in this trade, JP Morgan is paying more money, or rather it means variable swap payment. JP Morgan to Ford, JP Morgan is paying Ford to JP, yeah, and no, it's the other way. JP Morgan is paying, or Ford is paying the variable in our contract, right? This is what it is. JP Morgan to Ford, this is variable, so you don't know what it is. I did this yesterday night, this example, so I was half asleep. I'll fix that. Okay, so you calculate these, when say interest rates, whatever it is, it's a simple formula, right? It means a 4.91 quarterly interest rate, you calculate with simple calculation. Most important thing out here is that at this point in time, means that any day from now, swap will be revalued, right? Every day swaps are revalued, and that is the counterparty risk. And let's assume that, swap is being revalued after 1 month, right? This is just for simplicity, but swap would be revalued every month, every day. Okay, so that you know that what is the counterparty risk. And that is what results in margin calls. Lata, you had a question, right? What results in margin calls? So whatever your valuation changes on a daily basis, that is called margin call. So you calculate the market value for both fixed rate as well as floating rate out there. So there is a formula for that. So this is the fixed rate formula, is fixed rate cash flow multiplied by all the means say discount factors plus this thing, right? So you have the new interest rate which would come in. Now here, since you are revaluing after 2 months, right? It means since or rather if you're revaluing after 1 month, so now instead of that 3-month payment, your payment is due in 2 months, right? The second payment is due in 5 months, third payment is due in 8 months, and final payment is due in 11 months. So you have to use that 2 month, 3, 5 months, 8 months, SOFR rates, calculate the discount, means factor for all of those things, right? So this will be data which would be available. This is what the market data would be, right? There would be vendors who would be calculating and providing this data. So this is the market data which comes in. So you would have these calculations done, right? So the fixed rate value now is 1,006,259. So 1,006,259.259 million is the valuation of the fixed leg. Okay. Similarly, the floating leg would also be valued. So floating leg valuation formula is, means whatever floating leg cash flow plus notional into D4, right? So you have this formula with that you calculated the floating rate, this thing, right? So if you put it that, the initial rates and calculate it, it will come out as 0. Both will be, equal, right? That's why they say that value of the swap will be 0 initially. Now, in this case, when you look at it, value of fixed minus value of float is equal to 1.41, right? So since the interest rates have reduced, if interest rates have reduced, who is benefiting? Ford is benefiting, right? Because Ford thought that interest rate is going to come down. Therefore, they entered into this swap contract. So since the interest rates are coming down, so they are benefiting. So Ford is a winner as their outflow is reducing. So which means that they are benefiting from around $1.41 million out here in this case, right? And since, Ford is benefiting, so JP Morgan is losing this money. So this is the money which would be, it means, at risk, right? So tomorrow, JP Morgan fails, then this is the money which would be at risk for Ford, right? Because if JP Morgan fails, then Ford will not be able to recover this money, right? So that is Ford's exposure to JP Morgan, which means that, means whatever is the money they need to receive from them, that is their exposure, right? Now, exposure is a word which is, say, used very differently. So there can be gross exposure, there can be net exposure, right? It can be different types. So think of it like this: if you have 1.41 million as your exposure, but you have, means say 1.5 million worth of collateral already from JP Morgan, right? In that case, your net exposure is zero, right? Your gross exposure, definitely you have 1.41 million exposure, but you have enough collateral available with you, right? So which means your net exposure is actually zero if you consider the collateral position, but your gross exposure is $1.41 million. So that is the money which you would lose if the guy goes bankrupt. Okay, so that's the term which you use. What is the exposure out there? It's basically, it means exposure comes from the word expose, right? So whatever you expose, whatever is open, that is what is, it means, your risk. So your risk out there is 1004.84, which is the difference of the value of fixed versus value of float. Now, if the interest rate had increased, in that case, say Ford would be losing, which means that Ford would have, or JP Morgan would have exposure on Ford. Okay, so that's how you calculate your exposures and swap value. Every day, this swap value would be calculated. Every day or every week, or depending on whatever is in the contract, typically every day, it will be calculated, and you would have margin calls based on this change in value. Okay, so we'll look at how margin calls are done and all of those things, means, as we move a little forward. So Ford is a winner in this case out. Any questions on this interest rate swaps? When I give you this, deck, you will be able to do those calculations. You can look at those calculations and you will understand this. Okay, I'll fix this and then send it to you. Can I move to next one?
Yes, Ajit, Miss Exposure means now here Ford and the JPM. So who is losing? Miss like a JPM.
JPM is losing out there, right? It means because if you look into it, the payment which on the floating leg, whatever payment has to be made, that is now lower, right?
Yes.
And fixed leg, who is paying the fixed leg? JP Morgan is paying the fixed leg. So they have to pay more, right? As compared to whatever, means that this guy has to pay. So what is the net exposure? It is, say 1,006 minus 1,004. So that's the risk which Ford has, or whatever amount Ford is winning, because this is not settled, right? It means that this is, means the settlement would happen only after 2 months, and every day the price would change. But today, Ford is the winner. Tomorrow, interest rate may go up again, right? Something happened, it means interest rate suddenly increases, right? Tomorrow, job numbers look good, inflation looks bad, the interest rate is going to increase. So, again, the Ford, whatever Ford is gaining, that Ford would lose, and JP Morgan would gain back. So every day this number changes.
Yes. So this exposure, it is just calculated. It is not like a no one is like a.
No, it's calculated.
Calculate. Okay, got it. Means like a. It's like a. There is a difference between the calculated, that whatever we are getting the money from the floating rate, floating interest, and the fixed interest. So what is the difference between that? Is the exposure.
Correct? Yeah, so that is in this case, right? But exposure can be anywhere, right? So, say you you decide to actually means sell something to me, right? And means say let's say you said that or I said tell you that okay, I'm going to give you Tesla for $200. Okay.
Okay.
Now tomorrow Tesla's price has become 300. Okay.
Mm.
So what is your exposure on me? Your exposure is $100, right? It means
Correct. Difference.
because means the 200 was your agreed price. You have not paid me that money yet, right?
Mm.
But actually, even if you pay and I don't deliver, right? It means still, means you will pay only when I'm delivering. But if I don't deliver, you're not paying me. So you are losing $100 out there because your original amount you have not paid, right? So your exposure is $100, right?
So even if you say yesterday 200 and I didn't pay you yesterday, but today if I pay 200, will you give me the share because today's price is 300?
Yeah, so it means so that's why collateral and all of these can come into play, right? To ensure that I mean, say there is the counterparty risk is eliminated, right? That's why you take collaterals and margins and all of those things on exchanges. But if it's an OTC trade, I may say that no, I will not be able to pay you. Okay, and nobody because there is no guarantee in there. That's why you will not agree on a trade unless you're given some initial margin. So we'll talk about that as we move.
Okay, yeah, thank you.
Similarly, in a few, so if the contract has, I mean, say where linkage, so some one party is paying a fixed rate of interest and the other party is paying the interest linked to a security return or an index return kind of stuff, that is called total return swap, right? So let's take an example. So in a 1 year total interest return swap, right? It means if the two parties agree that one party says that Goldman Sachs says that means they will pay 6% interest rate, and or rather Berkshire Hathaway agrees to pay a total return of S&P 500. So Berkshire Hathaway is saying that we will pay you whatever is the index return, and Goldman Sachs is saying that okay, we will pay you a fixed 6% interest return, returns, right? So let's say quarterly return on S&P 500 was 1.2%, 6% minus 3%, and 2.5%. This is what every quarter the returns were, right? So you calculate the cash flows. So fixed interest, fixed leg, it is always 150,000, right? It can say 1 million, and so every quarter is 1.5. So it's 150,000 on a 1 million. Right, so 6% on 1 million trade, which is 600,000. Every quarter it's 150,000. So fixed payer, Goldman Sachs is paying 150,000. Floating payer, which is means a Berkshire Investments, in this case, first year return was 1.2%, so they need to pay 120, right? And they need to receive 150. So in this case, Goldman Sachs will pay Berkshire 30,000 in this quarter. Next quarter, it's means their return is 6%, right? So floating is 600,000. This is still 150. So which means that Berkshire Hathaway will have to pay Goldman Sachs 450. So every quarter it means you will have these adjustments. So at the end of the day, if you look at it, the net means Goldman Sachs has made 70,000 in this deal. Okay. So this is a total return swap. So somebody says that okay, means so this is betting, right? Berkshire Hathaway says that okay, market is not looking good for me for the next 6 months or 1 year. So I will pay you whatever is the market return. You just give me a fixed rate of return, and I will ensure that whatever is the market return, I'm going to pay you. So you don't have to really invest full money to invest into it, right? So if you wanted to do $1 million investment, you need to pay $1 million. But if you're entering into a swap contract, you can just manage it with 100,000. You don't have to pay 1 million out there, because at any point in time, whatever is the risk, you will be able to cover it, right? So with a small money, you will be able to still get that kind of a return. That's why you enter into a swap trade. Okay. Similarly, the third kind of swap is the currency swap. Okay. So in a currency swap, this is interesting, right? So why do you need a currency swap? So let's say Tesla wants to raise $100 million in Sweden. They want to set up a new plant, right? Now, what Tesla can do is that Tesla has money out here in US, they can convert it into euro and then invest in the plant over there, right? Or they can take a loan out here, convert it into means say euro and invest there. But in that case, they have to pay the money back in euro, right? So, or rather US dollar. So after 5 years or 6 years, they need to again bring it back and then pay it here, right? So in doing so, your currency risk comes into play because euro rate can change, right? It means you may have an interest rate which you may be paying or saving on it, but your means a currency may get devalued, or means a value may increase or decrease, right? So there is a risk associated with it. What is going to happen? Let's say if you take money and invest in India, right, and then if you have to give it back by that time, rupee depreciated by 20%, which means that you have to pay 20% more to bring it back here, right, and pay and return it to the guy who loaned you here. So in that case, you're losing a lot of money, and that's why you don't want to do those kind of things. So in those situations, companies enter into a swap contract, a currency swap contract. So typically what happens is that, means a Tesla would want to invest in Sweden and IKEA may want to invest in US, right? So what they would do is that they will have a swap contract, or there would be a bank which would get involved and they will have a swap contract. So in that swap contract, let's say Tesla US company wants to raise $100 million of Sweden to set up a plant. Tesla is getting a 3% loan from European bank because they don't know Tesla well. So it means that they charge 3% for giving loan to Tesla, right? But the same bank is offering 100 million to IKEA, which is a Swedish company, at 2%. Similarly, IKEA, a Swedish company, wants to raise $110 million to set up a furniture warehouse in the US, and IKEA is getting this loan at 5% in US, right? From US bank. Now, US bank is offering Tesla at 4% because they know Tesla in US very well, and they are offering Tesla at 4%, right? So Tesla and IKEA enter into a swap contract. What Tesla does is that IKEA would raise 100 million at 2% from the Swedish bank and give it to Tesla, and Tesla will raise $110 million in the US, right? It means and give it to IKEA. And the exchange rate between euro and US dollar is 1.1. So that's why it means I adjusted it that way. So this way both firms will get benefit, right? If they enter into this currency swap. So now Tesla, instead of paying 3%, they are now paying 2% interest. Similarly, IKEA, which was supposed to pay 5% interest out here in the US, they are just paying 4% interest. So both companies benefit out of it. So for this reason, they enter into currency swap. So this is how a picture would look like. So, IKEA would pay 4% interest rate out here, and to the swap bank, and swap bank will pay to Tesla, and Tesla will give it to US bank, right? Similarly, means that Tesla will pay the 2%, whatever that euro rate, to swap bank, and swap bank will pay it to IKEA. IKEA will pay it to the European bank from where it has taken the loan, right? So they will have that. Can I? Okay. So that way, this contract would work, and means say after 5 years, when both these loans will end, they will just simply exchange that money out. Okay. So they are eliminating the currency risk, and they are what do you call it? They're eliminating the currency risk, and at the same time, they are getting a lower interest rate. Any questions?
Ajit, in case,
Yeah.
Tesla goes bankrupt or IKEA goes bankrupt, what is the situation here?
Yeah. So therefore, they will always have collaterals, right? Again, it means that both these, means say the swaps would be valued on a daily basis, right? So you can say, so whatever is the exposure or whatever is the mark to market, because currency prices can change, right? So if currency valuation changes, then there is a risk associated. So for that risk, they will be exchanging on a daily basis, right? So even if they say if IKEA goes bankrupt, it doesn't have an exposure, right? It has given 110 million worth of loan there, so they will not pay that part. So means you already have some collaterals associated. So whatever it means say factories or whatever you are means say setting out here, you put it as a collateral. So they will have sufficient collaterals to cover that. Okay, so that is what the collateral management's role is, which we are going to discuss. So this is how the swap contracts work. Naturally, swaps would be valued on a daily basis, just like I gave you the example of interest rate swaps. Similarly, all the swaps are valued on a daily basis. Okay, because here in this case, the interest rate would change, therefore the valuation would change. In this earlier case, your index return would change on a daily basis, right? So your valuations would change. So every day it will be valued, and every day you will do a mark to market, right? So it means the current rate is, let's say, 1.2% return, but maybe it means in one day it gives 2% returns, right? So if it gave one day 2% return, which means that on an annualized basis it is very high, right? It is 400%, 500%. So you do a revaluation. So you would do a continuous valuation to see that what's my net exposure, and whatever is the net exposure, you would charge that. Okay, on a daily basis, you would do all of those adjustments. That's what collateral management business is all about. And finally, credit default swap. So credit default swap is something wherein, means that two companies are betting, right? So saying that, okay, that, if the other person goes bankrupt, I'm going to guarantee that I will make the payment for their loan, right? Let's look at from an example, right? So let's say Bill and Melinda Gates Foundation bought, Lehman Brothers bond. Okay. Now they heard that Lehman Brothers is little risky, right? It means that things are not going well at Lehman Brothers, and this is an actual incident which happened in 2008, right? So I just converted it as a case study. So Lehman Brothers, it means, said that Lehman Brothers is going, Lehman Brothers is not doing well. And therefore, Gates Investment Trust, right? Bill and Melinda Gates Investment Trust, they wanted to have some protection. So they went to AIG, and AIG has underwritten this thing, saying that, okay, you give me 2% of whatever is the amount you want to be guaranteed by me on Lehman Brothers, I will guarantee that. So 200 basis point is the per annum is the agreement on a notional of $10 million, right? Which means that 2%, which is 200,000, no, not 200,000, 20,000 is what Bill and Melinda Gates Foundation is paying to AIG, right? So to cover their risk. And if means there is the subject to credit event, right? Which means that Lehman Brothers defaulting, the entire 10 million will be paid by AIG to Gates Foundation, right? By the way, it is 10 million, so it is 200,000. I was just thinking that how can somebody take such a high risk? Okay, so it's like 200,000 is what they are paying. So every quarter they will pay 50,000 to ensure that means if Lehman Brothers breaks or Lehman Brothers go under, then their money is safe. Okay, they invested $10 million. They may be getting say 5%, 7% interest from Lehman Brothers. Out of that, they are giving 2% to AIG and saying that, okay, AIG, if something goes wrong, then you need to guarantee me you are going to give me the 10 million back. So that's the contract. So here it means in this case, the reference asset is Lehman Brothers, because it's all based on if Lehman Brothers bankruptcy. Okay. So that is what happened. And the maturity date, let's say September 30th, 2008, right? So on September 15th, Lehman Brothers filed for bankruptcy. Okay. Now, since Lehman Brothers filed for bankruptcy, which means the credit event has happened, and AIG is supposed to pay Gates Foundation $10 million. But the contract says that means I will pay you whatever is the recovery amount, right? So when the recovery of Lehman Brothers happened, like say Lehman Brothers went under, so they liquidated Lehman Brothers. So the CDS, the investors of Lehman Brothers, right? The fixed income investors of Lehman Brothers, they got 15% money back, which means that 1.5 million they got back. So 1.5 million they got back from the recovery fund, and 8.5 million balance is paid out by AIG, which is the insurance company. So that's why AIG also went into issue, because AIG insured so much that AIG did not have money to pay all the investors out there, and government had to step in. Okay, so that is the 2008 crisis. So that credit default swap was one of the big crises. So Lehman failed, but Lehman's all investments were guaranteed by AIG and different other banks out there. So everybody had to take a hit on that. Credit default swap was a big business. Okay, so every day, whatever depending on the probability of Lehman going bankrupt or whatever it means, the risk ratings and all, they will calculate whatever is the value of swaps, and then again any risk what is there, it means that would be called in as a collateral. Okay. Because Bill and Melinda Gates Foundation comes in and says that, hey AIG, you know what, actually means you said you're going to cover, but you're writing so much contracts that I don't have trust in you. So can you give me something as collateral? So they have to move the collateral out there. So that's how collateral moves in the case of credit default swaps. Okay. So this is about 2008 crisis, right? So Lehman collapse means it led to all those situations. Some of you may have been really young, so you don't know what really happened, right? But that led to big events in the market, right? It means Warren Buffett always called these derivatives instruments financial weapons of mass destruction, right? Just like you've seen the outstanding value, whatever it is, right? It's 632 trillion worth of outstanding value. 17.8 trillion values of swaps are in swap values are in play, which means that 17.8 trillion dollar is the exposure which firms have on other firms. So somebody going bankrupt can have a domino effect on the entire system. So that's why Warren Buffett always calls it as derivatives are financial weapons of mass destruction. Okay. But all the investment banks out there, they want to make money, so they continuously trade, right? So to handle that, you have credit risk. So naturally, it means when you have a counterparty on which you are taking the risk, right? It means then that is called as credit risk, right? Or the default risk out there, that the borrower or the counterparty will fail to meet their financial obligation, leading to loss to lenders and investors, right? Just like in this case where we saw the example of Ford. If JP Morgan goes under, then Ford will lose that money, right? So there is always a credit risk attached with it. Similarly, if say Ford goes under, and if JP Morgan was winning, in that case JP Morgan carries that risk, right? So to mitigate that risk, you use collateral management, but typically we looked at this time, right? So one of the things which came in is that you need to look at exposures across the enterprise, right? You would have different legal entities within a company, but you have to look at always the exposure at the entity level, the corporate level, right? So for example, if you look into Lehman Brothers, they had some 1,700 entities out there, right? Everybody thinks that, oh, my exposure to Lehman Brothers is only $1 million, right? But then Lehman Brothers at the parent level had an entity exposure of almost like some $8 or $10 billion, and that resulted in this fall, right? So $1 million from Lehman Brothers balance sheet perspective looks so small that you'll never be worried. But at an enterprise level, when you calculate it, aggregate it, you realize that okay, it is billions of dollars, and now you start getting worried. Okay, that's where collateral comes into play, right? So which means that you and me. Okay, any questions on the derivatives before we move into collateral? Okay. So in collateral, naturally, collateral means means say something which of value which you give in guarantee to ensure that the other party is not at risk, right? Just like, your bank gives, when the bank gives you a car loan, your car is a collateral with the bank. When bank gives you a home loan, your home is a collateral with the bank, right? So it means that they always take 20% or 30% from you and they finance rest of it, right? So they will take a margin or a deposit from you so that their exposure is not full amount, and the house is kept as a collateral at their end, or car is kept as a collateral at their end, right? So in financial markets, say what can be given as a collateral? Cash can be given as a collateral, or securities can be given as a collateral, right? And who are the counterparties or who invest into all of those things? It's all banks, brokers, asset managers, hedge funds, pension funds, companies. All of these people will, have these kind of investments in which they invest, and that results in collateral requirements, right? Collaterals, what are the different products for which collaterals are used, right? So first is the repo market. So that is the largest market where collaterals are used. Okay. So repo, anybody knows what's a repo?
Repurchase agreements where you repurchase the contract which has been agreed on.
Yeah. So you give a security today, let's say instead of, giving a loan or any of those things, you just simply get into a repurchase agreement, which means that I sell you Tesla at 200 today, and tomorrow I am buying it back for 200.50, right? So which means that, say you are giving me money for one day, and tomorrow I am giving it back and I'm buying the security at 200.50. So there is a repurchase agreement, right? It means you sell today and buy back tomorrow, or 1 week or 1 month, right? Whatever is the term of it, right? So it means you agree on to it, and that's a repurchase agreement. So there are two legs out here. First leg is the trade where you are selling, and second leg is where you are buying it back, right? In swaps, you had two cash flows, so you had two legs out there. Here, in case of a repurchase agreement, you have two legs out here where you are selling a security and buying it back on a future date, right? So you have two legs out there. So that's those kind of products are called legged products, right? Or leg products. There are different types of leg products. It means exotic options. They've created hundreds of different types of leg products that you need really to sit on it to understand what those kind of products are. CLOs, CDOs, you will have, it means a whole lot of permutation combinations they created, very, very complex products out there. Somebody has a question out there. Okay. Varun's question is, can we use gold as an asset? The other person, whatever they agree, can be used as a collateral. Okay. So when it comes to US markets, right, it means for your equity derivatives, or sorry, for your equity lending and all of those kind of stuff, only cash is accepted as a collateral. In the securities lending market, if it's about equity lending or it's about corporate bond lending, only cash is accepted as collateral. When it comes to Europe, they accept other securities, government bonds as collaterals, right? So it depends on market to market. There is no hard and fast rule as to what can be accepted. Somebody says that, okay, instead of gold, I am ready to accept, say microprocessors as collateral. I'm okay with that, right? Or it means if I want to give my real estate as collateral, I'm okay with that, right? Or if you're okay with that, then that's a collateral. But generally accepted in the market, whatever it is, that is cash and securities, which are stocks and bonds. Okay. So what are the products in which you trade? So one is repo. Second is securities borrowing and lending. As I said that, say if you want, say you are a hedge fund, you think that Tesla is going to do bad in the next 6 months. You don't have shares of Tesla, but you go and sell Tesla, say 100,000 shares of Tesla. You go to an asset manager and say that, hey, you have 100,000 Tesla, can I borrow from you? So you borrow means say from them and deliver it in the market. So when you're borrowing, you need to pay them collateral because they want to ensure that you will return it back, right? So you give them cash collaterals because when you sold, you got cash, right? So you give them cash collaterals and ensure that means say whenever after 6 months Tesla prices become 100, so you buy in the market and give it back to them, right? So you made $100 on that, and you would have an agreement with them that for every week I'm going to pay you $1. So maybe it means say in 20 weeks you paid $20, but you made $100, so your net is $80 profit, right? So you get into that securities lending and buying agreement out there, depending on whatever agreement you set up. Or else you can have some cash as a collateral. In that case, means say no fee is paid, but whatever is the interest earned, that is distributed between the parties, right? The collateral, if it's a cash collateral, then you typically invest in repos or overnight market, and then whatever interest is calculated is received, that is shared between the parties out there, which is the borrower and the lender both will share that revenue. Okay. OTC derivatives trading, you need collateral because you and me enter into a trade. So both of us don't agree with each other that, means say you will default or the other person will default. So instead of to de-risk themselves, they will move collaterals, right? And then securities trading itself. So when you buy or sell shares, so they will give you limit, which is called as margin trading. So your securities are held as a collateral out there, right? Based on your collateral, you will be getting. There are two types of collateral arrangement. One is called a bilateral model and one is called a tri-party model. Okay. So in a bi-party model, what happens is that there is an asset owner and there is an agent lender out there, right? Who is lending the security. So State Street acts as an agent lender, maybe. Right? There's a. What's the question? In terms of tasks and responsibilities, what does a BA do for the organization? Yes, we will talk about that towards the end, right? So, okay. So from the first part, from a derivative standpoint, the BA's responsibility would be, depending on the tool they are building, right? So they may be building a tool which helps you price the derivatives. Whatever is the market value of the swap, they need to calculate the market value of the swap on a daily basis. Or if you are getting into an agreement, right, it means you need to calculate that what is going to be the fixed interest rate. The variable interest rate, you need to calculate the fixed interest rate, what it is going to be. So you would calculate that fixed interest rate, right? It means to run that. So you will build softwares for all of those things. From a requirement perspective, where is the data going to come in from, right? If you have to value your derivatives, you have different models to value those derivatives. So you have to implement that model. For model, you have to bring in data, your market data from different places, and you feed that data. So connecting with those data sources, that is the other thing the BS would do. All the screens which needs to be built for the traders to really work with, that would be something which the BS would be building, right? So all of those kind of things would be done by BS. But we'll look at all other things that BA do as we move forward. Okay. So next is there's a bilateral and a tri-party model, right? So in a bilateral model, there's an agent lender who would interact with the borrower's intermediary out there, and they're talking to each other and they manage everything, right? It's a bilateral model. In a tri-party model, there is a tri-party agent who comes into play.
Ajit, can we go for the bilateral? Can you talk? Yeah, fine. Let me understand what happened. Okay, I have the JP Morgan and I have the Goldman Sachs. Okay, there are two parties. Okay, bilateral.
Yeah.
So how what the state is doing? Okay, you are the right now. You can think is you are the Goldman Sachs. So I am the BNB Paribas. Okay. Yeah.
So let's put it that this is the asset owner. So asset owner is BNP Paribas. Right?
Okay.
And this is, say Goldman Sachs who wants to borrow securities. Okay. So JP Morgan, so Goldman Sachs will reach out to BNP Paribas or their agent, which is State Street in this case, and say that I want to borrow 100,000 shares of Tesla. Okay. So,
Okay.
so means they will say that, okay, 100,000 of Tesla, give me, means say 200,000 in cash as a collateral. So JP Morgan will, or Goldman Sachs will move the cash to this guy. It means a State Street, and then the transactions would end out there, right? It means they would means say doing it one, it's a directly interacting between them. So that's a bilateral model. So where agent lender, which is State Street out there, is interacting with Goldman Sachs out there or JP Morgan out there, then that's a bilateral model.
Hold on here. Like, see, like Goldman Sachs wanted to get the shares from the BNB Paribas. So Goldman Sachs told State Street, okay, I want to borrow the shares from the BNB Paribas. So say, okay, so he will say, okay, I will give it to you, but on that you have to give me the collateral. Okay, so that collateral he will give Goldman Sachs to BNB Paribas, correct?
Yeah.
Yeah.
But it will be, yeah. So custodian is State Street out there. So they will actually move it to State Street. So State Street will act as an agent out there and then, help them facilitate. But the transactions could be between, I mean, say Goldman Sachs and BNP Paribas directly. Okay. So whatever agreement, say, say BNP Paribas tells State Street that take 200,000 as collateral from them. So they will just take 200,000 collateral from them. State Street is just acting as an agent between these two guys. So whatever BNP Paribas is telling, State Street is going to execute that, right? So they are not taking any decision on behalf of. They say that say that BNP Paribas says that I need 500,000, then they will just simply tell JP Morgan that okay, they want 500,000, and say once they get the 500,000, they will tell BNP Paribas that we got 500,000. They're just acting as an agent, but it is the actual trade or actual contract or everything happening between BNP Paribas and JP Morgan. That's a bilateral relationship.
Okay, but what is the benefit of the like how the state is like survives? What is his fees? Means how he
Yeah. So State Street will take a cut out of that. So for example, JP Morgan is paying, let's say, $20 for the transaction to BNP Paribas. So out of that, 80% will go to JP Morgan or to BNP Paribas, and 20% will come to State Street. So $4 State Street will get, and and this thing BNP Paribas will get $16 out of that. So they're
Okay.
typically an 80-20 split out there.
Yeah, and here is like a last lecture I saw your that color. You showed that plus value and that negative value. So I did not understand what is like a plus value means. The margin is getting, we are
Yeah.
calculating the margin, the plus value and negative value. I didn't understand what is the difference.
Yeah. So what would happen is that, say it's a zero sum game, right? Which means that if I am losing $100, which means you are getting $100, right? So one party will have plus and one party will have negative. So whoever has plus, they will ask for more collateral from the negative party, right? So you have to calculate the positive and negative or to understand that okay, how much money is to be received from the other party, right? So whatever is the profit or whatever is the loss, you have to, that's a mark to market, and you need to get that mark to market on a daily basis.
The positive elements, can you give the example? Okay.
Yeah. So as we go further, it means you will see those examples out there.
Okay, yeah, thank you. Because last lecture you explained, but I did not understand. Someone like a Pico, someone they asked the question. You are like a showing that Acadia, that choline, or
Yeah.
things that.
I will explain. So you did not attend that session, so we'll do one-on-one.
Yeah.
Okay. So in a tri-party, what happens is that say another company comes into play, and they will manage all the collaterals for you, right? It means instead of say directly dealing between the two parties, there is an agent, tri-party agent comes into play, and they will manage all the collaterals for both these parties, right? So, and they have something called long box, right? So the borrower, what did I? Okay, yeah, sorry. So So in that case, means say the borrower will move whatever collaterals they have to a long box. Long box means, whatever long position they have, they put it into a box and say that, okay, these are the securities which you can use as a collateral. I have made you as an agent out there. So you negotiate with my parties out there and, means say give the lowest collateral possible, right? So I've given you different collaterals out there. You look at it and see that what is the best collateral that I can give it to them, what is the worst collateral I can give it to the other party, which they are ready to accept it, right? So this tri-party agent would negotiate with them and say that, hey, you know what, it means is that everybody wants Tesla shares, right? It means, or rather, it means say US government bonds as collateral, right? But or cash as collateral. But I have some Tesla shares out there, or I have some, means say bonds issued by Tesla out there, right? Nobody accepts it as a collateral, right? But there are some people who would be ready to accept it as a collateral. So how do I find them and give that as a collateral to them, right? So how can I optimize my collateral best way? That is what this tri-party agent would do. So the tri-party agent would, means deal with the borrower, and it will work with the agent lender as well to ensure that means this collateral management process works smoothly, the optimization works smoothly. So there are very few players who do the tri-party business today, right? If you look into the market, it was something which started by JP Morgan. JP Morgan was the first tri-party agent. Say then BNY Mellon also started. Euroclear and Clearstream in Europe was doing this, and recently State Street also started in the last 2-3 years. Okay, this tri-party collateral management service, where they would have, say, a long box, so all their clients can put in their shares into long box, and State Street would decide that what they want to give it as a collateral on behalf of the customers. So they will ensure customers' interest in place. They will always give the worst quality collateral to the other party, which they are ready to agree. Because I want to give, but the other party is not ready to agree, then how can I do that? So all those negotiations, everything is outsourced by these agent lenders, the borrowers to agent lenders, to give the worst quality collateral first, right? So that's what they try to do. They try to ensure that the best things are always kept in their books, and whatever is the worst things, they give out as collaterals. And that is
Ajit here, agent lender also State Street, tri-party also agent is a sorry, State Street, means how they are working, like miss I didn't understand.
Yeah. So that's another advantage in this kind of a business. So all those agreements are always written, means there's a contract which is already there, right? The contract,
so it is like that I am working working 2 roles, okay, and I'm getting money for both, means I am working as a realtor also, and means
no. So these are 2 different divisions. Okay.
Okay.
These are 2 different divisions out there, right? So just like in securities trading, I can, say you place an order with me to go and buy in the market. I can give it from my inventory as well, right? So that's a conflict of interest. If you look at it that way, hey, I am selling and you want to buy, it means so instead of advising you not to buy, I'm selling for this reason, I am just executing the trade for you, right? So there's a conflict of interest, but it doesn't work that way. So the securities lending division, which is lending, that's a different division as compared to your collateral management division. So there's something called fiduciary responsibility, right? So the collateral management group, or their fiduciary responsibility to take interest of their clients out there, which is, if they are the tri-party business, it's their responsibility to give the worst collaterals to securities lending division of State Street. Securities lending division of State Street has a liability to ensure that means whatever is the acceptable collateral on behalf of the client, they are going to take that only, right? So both groups are different, and they would have a software to do this, eligibility testing and all of those things based on the rules whatever has been created. Okay. So as we look into this process, we will understand.
Yeah, and one more thing, who is the right now long box are you using? Like I know the State Street started use, was any other client?
Yeah, so JP Morgan was the first. State Street just started. JP Morgan had it for ages. Okay. Bank of New York Mellon had it for ages. And those are the only two guys who had it in the US. And in Europe, it's Euroclear and Clearstream both have this, right? Now State Street is the third one who started.
The long box concept.
Long box concept. Yeah.
Okay.
Okay. So this is the means advantage what say State Street would sell or somebody else would sell, right? So they'll say that okay, so tri-party, you would have settlement service, bilateral also, means say the agent provides the settlement services. The tri-party, you can have an internal settlement, right? So just like what we were talking right now. So you don't have to do the securities transfer all the time. If I'm managing it for both the parties, I can just manage it in my books itself, right? Which means that the cost is going to be lower. You don't have to pay for the securities transfer fee and all of those things. You don't have to pay for that. So that is one big thing, right? So segregation, again, it means you can manage all the books separately. So that is there in both cases, right? Long box is not there in the bilateral piece, right? Collateral pre-selection. So some of these things which you pre-selected saying that, okay, this client, I'm going to give this only and those kind of stuff. So you cannot do a pre-selection when it comes to bilateral, right? Then collateral valuations, again, let's say the tri-party provider has a fiduciary responsibility to do the valuation on a daily basis and ensure that proper collaterals are there. So they will have the collateral valuation services out there. They would have the optimization services, right? Optimization services means the lowest value collateral is something which I'm using first, right? So I'm using my optimizing whatever I'm giving as a collateral. So I'm trying to give the worst collaterals first, right? So those kind of services are provided by tri-party. So that's the advantage in a tri-party model as compared to bilateral model. Okay, but tri-party model is very costly to build the platform and do all of operations and all. So now, since the volumes have really picked up, State Street is entering into it. There would be other banks who would enter soon. Okay, moving on a little faster now. So collateral management process. So it's basically creates a process where two parties are exchanging assets. Okay. Now, in the last few years, right? So after the 2008 market crash, where we looked at it, when you looked into those pictures, clearly saw that credit default swap was one of the biggest issues for the 2008 crisis, right? It means an interest rate derivatives was a big problem out there. So there was a regulation which came into play, which is called UMR, right? UMR is uncleared margin regulation. It's actually called UMR, but I just used UMR regulation as a word out here, but that regulation is being repeated out there. So UMR came into play. So it said that whenever a transaction is happening, right, you need to get a minimum initial margin from both parties. In the earlier days, what happened is that, JP Morgan would say that, hey, you know what, I am a big boy, so I will not give margin. But if you're a small bank, if you need to trade with me, you need to give me margin, right? So these guys used to, bulldoze all these small investors and all of those things. So they say that we will not give you margin, but you have to give me the margin, right? And since Lehman Brothers was a big bank, AIG was big, right? And means all these big guys defaulted. So regulations are brought in and said that okay, nothing doing going forward. Everybody has to give margin, whatever it is. That minimum margin everybody has to give. And that is called initial margin. How it is calculated? It is calculated based on the instrument, right? Every instrument would have a different calculation methodology. And that is typically defined under a calculation called SIM, which is Standard Initial Margin Model. Okay, so depending on whatever is the instrument, there is a SIM, which is their SIM is that model which is used to calculate whatever is the initial margin. Okay. Then, as we looked at it, right, it means at the initiation of the contract, the value of the swaps or the derivatives contract is 0, and every day that swap would have certain value, right? Which means that, that's called variation margin. So every day, whatever is the value which is changing, you need to exchange that as well. So that's called as a variation margin, right? Third, it said that, okay, so, means you need to have collateral management. You need to have clearly call out whatever is the eligible collaterals and all of those things. So you need to have a proper process for that. So agreements came into play, right? So that ISDA, credit support and exchange, the document came in, and that lists all of those things, right? Then there are some terminologies which we will actually discuss as we move forward, right? So credit support and exchange is the document which is where all the collateral values are, means set up, or all the contract terms are set up. All of those things are in there. So one of the things which BAs do would be, means in the initial days in the junior BAs or the ops team BAs, what they will do is that set up the contract terms into the system, right? It means whatever is that collateral management system. So you would set up all those, extract all of those contract data from there, and then set it up on the system. What is the asset which can be agreed? What is the valuation methodology? When is the valuation going to be done? How would the collateral substitution happen? All of those things they will enter into it, right? So those are the junior business analyst roles out there. So senior business analyst, as a part of the platform build team, they will be creating those screens where all this data is being entered, or those data being enhanced, or means a certain law business rules for that, right? So it means writing out all the business rules out there, how the configuration is going to be, where the value is going to come in for those securities, or means say what kind of securities are in there, how it connects to reference data. So all of those analysis would be done by the business analyst out there. Okay? What are screens going to be? So they are going to design all of those screens. So threshold is the minimum amount, or the amount up till which you don't need a collateral. So JP Morgan and means State Street enter into an agreement saying that, okay, threshold amount for this is, let's say, 500,000. So up to 500,000, you don't need to move any collaterals, right? So if the value of the swap or that agreement or whatever it is, if it is less than 500,000, then you don't have to move the collateral. But that is not at one contract level, right? It is at the overall enterprise level, right? So you have that minimum threshold, which means that I'm ready to take that much risk, right? Stock market is all about risk, or financial market is all about taking risk. So there is a minimum risk which I'm ready to take, and that risk, whatever that amount is, that is mentioned under threshold. Okay. Initial margin we discussed. So initial margin is calculated using, means typically using SIM, but it is, when the way it is done is that you want to ensure that if the market crashes, something happens, you have enough margin to manage the risk for 20 days. Okay. Third is the variation margin. So unrealized profit or loss on a daily basis, that would be exchange. So that is the variation margin, right? Margin call. So naturally you calculated the variation margin. So you need to send a message to the other party saying that, okay, this is your means a margin. So you need to submit this margin, right? So you need to send a message to them. In the earlier days, it used to be all based on emails, faxes, and phone calls. But now the systems have been built, right? So business analysts would work on those systems. Means so Acadia Soft is a platform which is used for margin messaging. Everybody is on that same platform, so you are just means sending message from one person to another person, right? That whatever is that, so it is all recorded over there. So business analyst role out there would be to it's a one that build an interface with Acadia, then ensure that all the margin messages, whatever they are sending, it gets means shown up on Acadia Soft as well. So how do you manage that? And then to send the message, what do you need to do on your screen, right? How do you compute the margin based on your screen? So those are the kind of things which a business analyst would be dealing in terms of designing the screen, right? Margin call we discussed. So minimum transfer amount, right? Now that is
Ajit, one question. For the margin that's positive, suppose you and me, okay, like counterparty, okay. So if you are getting money from me, so in your account is positive. So when it is negative, like how the negative things it will be done. I
Because
understand, like, okay,
if
whenever if you get the money, it will be the positive in account. But the negative account, whose account will be negative?
the other party who is sending the margin,
See, suppose I am sending you $100 to you. So in your account, $100 positive. And
your
from
account,
my
it will be $100 negative.
okay.
Okay.
Okay. Yeah. Thank you.
Okay. So minimum transfer amount is the minimum amount which, means that they agree that this is the amount which we are going to exchange. Okay. As an example, that today, means say you and me, so say, your bank charges $10 to exchange money, right? It means, and to send the margin, to follow up all of those things, my cost is $100. Now, if I have a margin difference of $50, I will not ask you to send something, right? Because, means if you send something to manage all of that, my cost is $100. So typically you agree on a minimum transfer amount. That is, means until your requirement reaches that level, you will not ask for that the transfer amount, right? So that is the minimum transfer amount, which says that, you will not issue a margin call if the requirement is less than, say, whatever number that minimum transfer amount is, right? Then mark to market, right? So you do the valuation on a daily basis. So you do the valuation of your collateral and you do the valuation of your positions as well. Think of it like this, right? So you have given me Tesla shares as collateral, but now tomorrow's Tesla's value has gone down, right? It has become some $200 to $100, right? Now I will not, and you give me Tesla worth 200,000 initially, but now its value is only 100,000. So every day the collateral which has been provided, that is also valued and taken into account to say that what is the new margin required, right? If the Tesla's value has gone up, then maybe it means there was a margin requirement, but then since the Tesla's price has gone up, you don't need the margin. Or, means there was no margin required, but Tesla's price has come down, which means your collateral has reduced and therefore a margin is required. So depending on mark to market for your collateral position as well as your actual derivative, your margin calls can happen, right? So MTM is what it means you calculate the mark to market.
Yeah, I just one more question. See, the now the like we bought like a individual people. If you we I bought like just example, I bought a Lucid shares like $5,000, but it got like a loss now 1,000. So we cannot get the collateral, correct? Because that is a risk, because it is the Lucid shares is gone down. So we are lost like 4,000. So how we will be going to be
That's
covered?
your investment loss, right? That's your investment loss. You who can you ask collateral for? You are not giving anybody any shares or anything. That was your investment decision, right? Collateral is for when you are lending securities or you're giving somebody loan.
Okay.
Okay. Or you are having a derivatives contract where the settlement has not happened. In your case, when until you bought your shares, right? Your account, means you are not allowed to trade until you have money in your account, right?
Yes.
So that is the collateral which the bank is asking you for. Because means the bank wants to ensure that means if tomorrow Lucid share value falls, you will not pay them up. So they want collateral, which is the cash collateral. When you pay them money in advance, that is basically your cash collateral. Okay, we'll take that separately. So independent amount, right? Now sometimes what happens is that your standard collateral agreement, it says that it will be say 5% or whatever number, but a black swan event can happen, right? Or you say that, okay, I'm going to value it on a weekly basis, but a black swan event can happen, like a Silicon Valley Bank can go down and all those things can happen, right? You cannot wait for 1 week to do the valuation. You may have to do an intermediate valuation, and based on that you may want to ask for additional collateral, right? So that amount which you may ask in between, right? That is called as an independent amount to carry any mark-to-market losses or any of those things independent of your regular collateral call. That is called as an independent amount. These are terms which you should know if you're working in collateral, right? That's why I'm just quickly explaining. Next is haircut. So haircut is simple. So if you give securities worth $100 right? It means that they will give you a value of 90, 95, 98, depending on the risk on the security. Typically, if it's a government security, they will give 98% value. If it's a corporate security or an equity, they will give you 95% value, right? So which means that if you give, means a $10,000 worth of security, it is considered as 90, say 9,500 value as collateral. So that the difference which you're cutting, that is called haircut. Okay. So naturally, collateral, when you give, there is always disputes which happen. Okay. So so from a dispute standpoint, it could be because the valuation methodology, your valuation, whatever you are showing, that is not correct with the counterparty's valuation. Therefore, there can be a dispute. Or else it means that the data which you use or the model which you use to calculate the data which you fed was not correct. Right? The data which your vendor has sent in, that data is not correct. Therefore, your system is showing some methodology or some margin requirement, whereas the counterparty is showing different margin requirement. So you guys talk and resolve that difference, whatever it is, right? Or the value of the previously posted collateral, right? It means it has reduced or whatever has happened. So you will have a dispute on that, right? Or else it means so it is within the threshold limit, but means say you are making a call, whereas it means the other party is not ready to do that. And typically, say if it's, let's say your collateral, your threshold amount is, let's say $10,000, right? Now you have 9,999 based on your valuation methodology, whereas the other party is saying it is 10,200 because of the rounding error, right? So you would be taking at the 4th decimal place, they are taking at the 5th decimal place, and that is resulting on $1 million. It can result in almost like $100 difference, right? So because of those things, there can be collateral disputes which needs to be resolved. So whenever you raise a margin call, the other party can dispute it. If they dispute it, then you need to resolve it. If it doesn't means resolve, then you go to the arbitration committee to resolve it. Collateral substitution. So this is again, it means you've given something on collateral, but you want to change it with another security. That is called collateral substitution, right? Rehypothecation. So whatever collateral you are giving, somebody else can, means say, or the other party can use that collateral to give as a guarantee to somebody else. Then that is called rehypothecation. So in the collateral agreement, it will clearly call out, can I give the collateral which I received to somebody else, right? As an example, you have a contract, so you received gold from somebody, you've taken, maybe you've given a loan to somebody with a gold, right? And the party comes back and asks for the gold, but means you have rehypothecated or you have given it as a collateral to other bank as well, right? Now if the party comes back to pick up your stuff, means you need to go to the bank and get it. So party will get worried. So in the collateral agreement, it is clearly called out if that can be rehypothecated or not, right? Your securities, what you're giving as collateral, can it be rehypothecated or not? That is clearly called out. Okay. This we discussed last time, right? The collateral management system. So it would have those different input data systems. So legal agreement, static data, all of this is being set up. Front office is where all the trading would happen. So based on that trading, all the data would come in, right? You would have accounting where all the postings would happen. This is a core collateral management system where the agreement would be set up, the dispute management happens, portfolio reconciliation happens, interests are calculated, all of those things happen here, right? And then there would be market risk, credit risk, and all of those things. So you would have interfaces to these systems out there. Whenever the collateral is done, you have to make those payments or move those systems. So it will have connection to the settlement systems and all from where the data is being sent out. Okay? So this is how the margin call process works. And this is one important part. So BAs, means from a BA standpoint, means it's important to understand the margin call process, because the key thing which they would be working is on calculation of margin, or sending out the margin calls, receiving the margin calls, right? All those interface built out is something which the BAs will be responsible for. So you start the process, you will receive the feed from your different systems, right? So all these feeds, whatever you're getting, that is all BA's responsibility to how the feed has to come out, what data format it will be, what will be the extract look like, right? All of that data, sourcing the data from databases is BA's responsibility. Okay. So they would write the specs for sourcing all of that data. Once that is the
Yeah,
data
Ajit, yeah, this is very important because we have the dashboard only for the margin call process. So our BA, like she is doing all the like how daily how many margin call, like a counterparty, like a dispute and everything. So this is for the whole module. We have the for the margin call whole. We have the one module like a dashboard, and whatever you are showing the partially agreed, full agreed, margin call required, no, all this is a into that dashboard we are showing dispute everything.
Yeah. So BA is responsible for managing all of that, right? It means so technically
Very
speaking,
important. Yeah, it's BA's role. Yes.
so if you look at it, it means, say outside when you look at it, it looks like, oh, this is a very, very simple process. But the value of those agreements are huge. And that
Yes,
sixth
it's very
decimal,
huge.
seventh decimal place makes a big difference, because think of it like this. It's a $1 billion contract, right? So look at the number of zeros out there. You have 8 zeros or 9 zeros out there, right? Ninth zero, and if you have, which means that if an interest rate is being calculated, you have to go up till the ninth decimal place. If you do at the fifth decimal place or sixth decimal places rounding off, then it can, means you have hundreds of thousands of dollars as a difference. Whereas you go up to the last dollar, right? So you need to do a lot of analysis around that as to how the data is to be. Then the second thing is that for calculating all of these margins and all, your data will not be at one place.
It's very important. All this we have to like a calculate partially agreement, how many fully agreement, and the amount dispute, number of the dispute value, base call amount, all these things.
Yeah.
It's
So
very important.
So when you are uploading all of those things, right, a small data here and there would lead to dispute, and dispute means cost, right? Because means there are like 4 or 5 people involved in resolving those dispute, and that will take, means 3-4 hours to do that. If it's 3-4 hours and resolving that dispute, both firms, right? Just not your firm, the other firm as well, right? So it means 4 or 5 people involved in resolving all of those disputes. If it's 2 hours of effort, which means that, means both firms lost $500,000 on that, right? And your income for the day may be some $30-40 on that one contract. So so you need to ensure that the data quality is very, very high, and that's why domain knowledge, understanding of that data, and say analysis is very, very important. So based on that data, they will create and say that, okay, if margin call is required, then you send out the margin call. So you use Acadiasoft as a tool for calculating the margins and means sending out the margin messaging. If with the other contract you have, the other client is not on Acadiasoft and you need to send them with the fax or email or Swift or whatever, that's the other mode which you have to do. But you need to ensure that margin calls are going out, right? That would be something which would be done by operations team, but as a ITBA, you need to ensure that for doing all of those things, the data is available. Okay. Then if the margin call is agreed, then, say the process ends there, right? If not, then they partially agreed, then, say you move that partially agreed amount. That's the first thing, right? If half of it is agreed, then whatever is agreed, you just move that amount, and rest of the whatever agreement issue, you resolve it separately. Okay, but try to reduce your exposure out there. And these are large contracts, right? So everyday movement can be $1 million. That's why it means it's important to ensure that you agree and manage this process really well. So this is how it happens. So once the margin call has been accepted, right, now the actual collateral has to be moved, right? So if it's a securities collateral, the other party will, so assuming that you are sending out the margin call, you said that, okay, I need to have 2 million worth of securities or 2 million in cash as a margin, right? So the other party will come and say that, okay, I am going to give you this as a collateral, right? So you have to do an eligibility testing, right? Again, which means that, you are checking if whatever they are proposing as a collateral.
Ajit, can you please repeat? I lost some. Can you please repeat?
So once the margin call, they agreed on margin call, right? So the counterparty counterparty will set up a proposal saying that, yes, we agree that we have to pay you 5 million margin. So either I move cash or I'm going to send you securities, whatever they're going to do, they will make a proposal that this is what I'm going to give you. And you do an eligibility testing at your end, right? Saying that, means if that is acceptable or not. Right. So once that eligibility testing, which means that as per agreement that can be given, we will accept it. It's the right value, all of those things. There are some rules for that. So all those business rules will be coded by the business analyst for the eligibility testing. Right. So that eligibility testing is done. If means eligibility has passed, then means the proposal is accepted and the trade is booked. Right. But if it is not, then you call up the counterparty and say that, hey, for this reason, we are not able to accept this thing. Can you revise it? Right. And then they put a new proposal or a revised proposal out there, and then the eligibility testing is done. If the eligibility testing is passed, then the proposal is accepted and you book the trade. Right. It means so the other party will book the trade at their end, because whenever it means you need to book it on the system for the collaterals to be moved. Right. And so you book in your system saying that we are going to receive, say, 1,000 shares of Tesla from party X as collateral, right? And then when you book it, the settlement process triggers. So it's a free of payment, means a settlement, right? So you are going to receive the securities. You don't have to make the payment. In a normal settlement, it's a delivery versus payment, right? Which means that unless you make the payment, delivery will not happen, right? And in this case, it's a free of payment settlement. So the party is sending in this settlement, say the securities, and you need to instruct your custodian to accept it, right? So your custodian will accept that whatever it means you're sending in. So the custodian will get the notification that, okay, expect 1,000 shares of Tesla from X party. We don't have to make any payment. And that is what it is, right? So there will be specific MT 548 message which would be sent out to them. Once the settlement has been done, you will do a reconciliation. You have to receive $100,000 worth of securities from party X. So did they send all the 100,000 or not, right? So you do a reconciliation of that, and once the reconciliation done, your process ends. Next day again the same process would be done. Okay. There would be messages which would be sent. So this will be a Swift message which looks like this, the MT 558. So if you look at it, right? So this is the first message which has been sent, right? So once you send, so this is match and match, it's the process. As soon as means the other party also sends it, the message format, you will get a new message which says that, okay, with the future date it has been matched, right? Once that is done, then the third day, once means this is like instruction is being worked upon, so there's a new status update, and once it is fully settled and allocated, you will get a message saying that it has been set and done, right? So this is again the BS work in terms of defining what the Swift message is going to be, what tags would need what tag is mandatory, all of those things. BS would be responsible for defining the Swift messages out there, right? It's a standard format. So where are you getting this data from, and how are you plugging the data in there? So that is something which a BA would be doing. It's a pretty standard message, right? It means, but where this data is coming in from your system, that is something which you need to tell and create the screen so that it can be sent out. So that's it about collateral management as a quick overview. And system view, it means we looked at the system view, right? So this is where it means the system would look like. So there will be different processes. Everyday valuations would happen. I showed you how the valuation happens, right? The calculations out there. So market data would come in, and you would, so in this case, the market data, for example, interest rate swaps, market data would be whatever is the SOFR rates, right? And then means whatever is the discount rate, right? So discount rate can be calculated as well. So some vendors would send the discount rate as well. Otherwise, your system can calculate it based on how you want to subscribe, right? So and then your exposures would be calculated. Your collateral, whatever you have, that will be valued, and then see that, okay, what is the net exposure? Once the net exposure is known, then you will decide that if it falls within outside of threshold, right? Then can I send a margin call? If the margin call has to be sent, then all the data, whatever it means in needed for the margin call, that needs to be sourced and sent out as a margin call. And then, of course, it remains once all of those things move, right? It means if you get cash collateral, then it is invested somewhere, so the interest has to be split. So all those accounting about interest and all of those things needs to be done into the general ledger. I know this was too much, so I want you guys to go back and look at this video again, look at OTC derivatives as well, because this is one area where there are a lot of jobs, right? Collateral is increasing, and every firm has to work on collateral management. So there are a lot of platforms. So all these guys had in-house collateral management systems earlier, but now most of them are going in for vendor package implementation. So when you're doing a vendor package implementation, you need to have a lot of business analysts to do the entire data mapping. There would be some 10,000, 20,000 fields which needs to be mapped. So the entire data mapping would be done by business analysts. And then for all of these messages and all, you need to have screens to be built, business rules to be set up. All that work would be done by business analysts. But for doing that, you need to have the domain knowledge, what exactly that data is, right? So you need to have a good understanding of all of that. The products are very, very complex out there. I just took 4 derivatives out there, but if you go into the market, there are some 40, 50 different types of products out there. So for each product, valuation methodology is different. I just showed the valuation of one instrument.
Ajit, sorry, for the OTC derivatives and the collateral management, are you going to give us sample project that we can use as a business analyst, please?
We can talk about it, right? It means as a, so because, I would say that keep a simple project for this, say that you build a margin screen, right? It means say that monitoring screen. So
Okay.
So I showed you the Acadia screen, right? So with that, we know that, okay, so it means how does your margin dashboard look like? So you can say that, okay, so your project was to build a margin dashboard, right? So on the dashboard, what you had to do is that you have to bring in all the asset data, you have to bring the valuation data, you have to bring in your data from your GL to say that what's your net exposure, and then what is the status of margin call. So all the data which you wanted to show on your dashboard, you say that you were part of that margin dashboard system, which means that you interacted with all the other systems in there to get all the data and show it in one screen. So that project typically would take at least a year and a half to build it. And
we took 2 years, Ajit. Only got a dashboard, margin dashboard.
Yeah, so those would be long-term projects, so you can always quote that. See, somebody means, so how do I find out that, okay, some person is faking the resume, right? So when I ask them that, okay, so how long did it take for you to build this margin dashboard, right? A person who would have worked on a simple dashboard, they think that, oh, it's a simple data mapping. Maybe it takes 3 months, 4 months to build it, right? So they'll say that, oh, it was a short-term project. It was done in 3 months' time. If you really worked in collateral management, you know that this project would take at least, 2 years or so, right? So you can always say that, okay, so the first phase, the MVP was built in, almost 8 to 9 months. And then we had continuous enhancement. So the overall project was more than 2 years, but, the MVP was built in, say 8 to 9 months. So depending on, say how you are showing.
Yeah. So here is how the changes. Initially, the margin call we are develop that call status, but now they are increasing enhancement. They want the partial dispute. Previously, only we had like a full dispute. So the action call status every every release it will be changed. The filters are changing. Previously, okay, the no call required they wanted, but then next month they wanted to that action equal to no call they wanted, previously they don't want it. So each month they will the filter condition changing.
Yeah. So that project means write it. So look into Acadia, and then say the filter conditions, just like Lata said, right? So you can have different filter conditions. You can set it
Yeah,
up. Right?
layman language, I can say,
Discussion.
okay, I wanted to like a status, like a fully partial dispute. Okay, this one, next release, they wanted add the completed status also. Then another they wanted, and they wanted like previously it is showing the margin amount or total. Now they wanted counterparty wise. Okay, BNB Paribas 5 million this. Then they wanted to build a dashboard agreement wise. They wanted to margin amount like a CCP, OTC, how much.
Yeah, that's how actually means it will be. So, for example, it means say this one, right? So, if you look at it, means say this is the AB. So, this is at a counterpart. Means say this is at an enterprise level. Then you click it and say that okay, by geo level, whatever is the exposure, or by means say by
Yes, exposure amount. Yeah, we have to
exposure amount
calculate
by
the
this.
exposure
So,
amount by the
yeah.
counterparty.
Yeah, so you will calculate it by different views. You can create it, right? And
Correct.
this will be a custom level, right? So an executive would want a different view versus collateral agent would want it at a different view level, right? So when your first release or your MVP release, you did not have too many filters in there. You had that basic dashboard which is available. Now,
Yes.
as you add more and more users in there, you would add functionality which they need. So this collateral dashboard projects can be easily, say 2-3 years, whatever you
Yeah,
want.
and here is one more important concept: data entitlement. We have to give the permission. AGI person, he will see only AGI related agreement. Like he has an agreement with the Goldman, such a BNB, so he will able to see only AGI people in dashboard. You have to implement the data. That is which is the one of the important functionality.
Yeah.
AGI will see only the AGI record. Okay. Texas teachers will see only Texas teachers. So in dashboard, data entitlement plays a very, very important role.
Yeah. So
Otherwise, you have to pay millions dollars of the penalty. If another counterparty able to see another's people result, you are gone.
yeah. So that's basically it's a segregation of accounts, right? So that happens for a company like State Street, because State Street would have somebody working in State Street would be able to see position of JP Morgan and Goldman Sachs both, right? So now what can happen is that means I see JP Morgan's position, I see Goldman Sachs position. If I have both access and I pass on that information, it can create havoc in the market.
Yes.
So the rules or your contract would clearly say that okay, which all accounts. So I cannot work for multiple clients, right? It's a service provider. So means a service providers cannot work for multiple clients. So I cannot do it for JP Morgan as well as for say BNP Paribas out there together, right? If they are competing companies. So it will clearly called out, and I will be able to see data only for that particular company. So those are agreements a system. So as a business analyst, you need to ensure that means that rules and responsibilities, permissions at an account level, different level permissions which you're building for the data access, all of those things you would provision. So there's a lot of work for business analysts.
Yeah, and one more concept is here, like at the number of margin cost. So you can create like a dashboard, like I'm just like helping who was asking. You can create one dashboard like a number of okay, today you call like a number of 10 margin call, but how many calls fail or how many calls successful. That is also we like this month we built this dashboard. Number of margin calls successfully total is 5, and out of 5 how many successfully 3 and 2 is fail. That is one more 2 dashboard to develop.
Yeah, so there are different types of, so in the dashboard, so again it means so you can create different dashlets out there, right? So how many margins it means they went through, just like he said, because we think that we send a Swift message and it would get through. It's not necessary, right? Although it is means just like your email, right? Our thousands of email we send, some email may not go for whatever reason, right? If the internet was down and it remained in your outbox, right? Or the file size was too big or was corrupted, therefore it did not go, or it had some spam filter, it did not go. So same thing happens with messages as well. So messages fail. So even means even one message failing, it can have huge impact, because it could be a $1 million or $1 billion call, right? And the party goes under, or if market is volatile, then that's it. You're gone, right? It means so you as a customer is responsible for that. If means say a settlement message is to be sent out and the settlement message failed and you followed and you did not follow up, that's it. No, means you may end up losing hundreds of thousands of dollars. So there are big penalties as well as a part of these contracts out there. But long story short, means that's a project which you can show if you want to show, and you will be able to explain with whatever I told you, and looking into that Acadia Soft video. So there, it's a good view of margin dashboard is there. So you can means take a look at it and put it as a project, but get it in your picture. So whenever you're ready, right? It means whenever you do your analysis, have a interview call with me. I will ask you questions, and then means say that will give you confidence. But this is something which you can always show. Okay.
Thank you, Ajay. Thank you very much. This session is really helpful.
Thank you very much.
Ajit.
Okay, guys.
And thank you,
Good.
Lata, for sharing.
Thanks for staying long. Sorry, this was a long topic and had to be done together. That's why I had to take long.
Yeah. And if anyone from this, like, Ajit, how many classes remaining? Like, if anyone needed any help, just I am free to help.
Yeah, so we have 3 more classes left, right? So we have done 9. So we have one on securities lending, and we will do some basic, analytics out there. So that's the next class. Then we will have one on the wealth management, and finally one on transformation initiatives which are going in the industry.
Okay. Yeah.
Okay. So the transformation initiatives is something which I want to talk about, because those are things which means you can find jobs in those areas and how you can relate your experience out there. For example, this collateral management program, whatever is happening, this is a big transformation in the industry, right? Because of the UMR regulations.
Yeah, UMR. I am working on the UMR also, like so many data. So yeah, if anyone have, I'm really very happy to help. Yeah.
Okay. Thanks, guys.
Thank you.
Thank you, Ajit.
Bye.
Thank you, Ajay.
Bye.